Hey there, welcome to the video. I'm Scott Welsh, and we might be talking about the most powerful tool in trading today. So let's get right to it. Three things we're going to talk about. Divergence is the topic of our conversation today. We're going to talk about why it's powerful, what goes into divergence that makes it, at least philosophically, in our brains. You should be able to hear this argument and say, yeah, that makes sense. This might be a powerful tool. Then we're going to actually define it because it can get a little sketchy. And then we're going to do some examples of trades, and we're going to talk about some actual results. All right, disclaimer, please do not risk money you cannot afford to lose. These are hypothetical numbers as always. Got it? All right. Let's talk about divergence and its power. Now, when you look on videos or talk to traders or read about traders, you get a lot of different opinions. And opinions are, I love evidence, opinions, but a lot of traders swear by price action. Price is the only truth. Price is the only truth. And they believe in it, and that's what they use. Now, that is nebulous a lot of times because what does price action mean to you? Is it a candlestick pattern? Okay, then which pattern? Well, then how do you define that pattern? And then what happens next? Is it a breakout? Well, that's pretty easy. You use price to break out. I get that. That's trend following. I'm all on board. But then after price action, we have a whole new mess of problems. Breakout when? Breakout how? Breakout for how long? Use Fibonacci because that's based on price action, right? But that's kind of an indicator, right? You can see that it gets all sorts of really difficult arguments when you say price action, price action. And if you're a fan of the videos or a fan of my newsletter, you know I've analyzed and tested several price action systems, and none of them were superior. None of them. No price action system to date, 2019, has ever outperformed other systems. For example, an indicator-based system. So I'm a little skeptical of price action, except in the trend following format. But some traders believe in it. Other traders like to use indicators, like me. Love indicators. They absolutely work. How many more videos and posts do I have to make to prove that they work? But that's not to say that indicators are infallible. They are not. Something could stay oversold for a long time and overbought for a long time. You will get losing trades in indicators. You could get a lot of them, depending on how you use them. So it's not perfect. Well, there's a little bit of truth in price action, or else people wouldn't believe it. There's truth in indicators, or else people wouldn't believe it and use it, like me. But get this. Divergence as a concept uses both. I know. It uses actual price action to start talking about a trade, and then it uses an indicator to determine whether it's a good trade, a high quality trade. Combining the best of both worlds, it seems on paper that this should be a very powerful tool, correct? In fact, it might be the most powerful tool that we as traders can use. Let's move on. What is divergence? Well, for a long signal, and this can get a little sketchy, right? But we're going to define it and we're going to go with it. For our argument today, it's when price makes a new low, so it's getting worse, getting lower, but an indicator does not make a new low. That's divergence. Divergence? That's divergence, meaning price is getting worse, but the indicator is not. In other words, it's a quote-unquote weak new low. Yes, it's making a new low, but it's making a new low on a lot of optimism, and that means what? It's probably not going to stay low for long. Obviously, if everything is falling apart, if the market is going down and making more and more new lows, the indicator that we're looking at should also be making new lows. Everything's getting worse. If you go back to 2008, guess what you see? In the worst of times, price makes a new low. The indicator also is making new lows. Worse readings, new lows. But if that's not true, new low, but the indicator is actually better, more bullish, more positive, then going long becomes a potential of high quality trade. And shorts are opposite. If price makes a new high, but the indicator does not make a new high, then it might be a good signal, a weak new high. Now, it's great to talk about it. I wrote about it this week in the newsletter. Not easy to talk about it. It's easier to see it. So here we have it on our screen. On the left side, this cyan little mark here is MACD divergence. This is using price action, hooray, with an indicator, hooray. That sounded weird. But when there is divergence, this cyan line is drawn. Now, it's nice and confusing because this line over here is the same color, but it's an actual trade. I love having my winning trades in cyan. There is no logical reason to it, so I apologize for that. This is divergence. You can see there's no trade, and this has little markings for an actual trade. Okay, so I apologize for that. So we see divergence here, and we see divergence here, both of them long divergence. All right, let's take a look. Clearly, price has made a new low here, and then it made another new low here. This is obviously lower than that. Okay, so price makes a new low. So the indicator should make a new low. But when you read the MACD histogram reading down here at this bar, it reads negative 0.16. But on this exact bar, the bar that it made the new low, the MACD differential reading, the histogram reading, was negative 0.14. Negative 0.16, negative 0.14. This is lower, but that is not lower. When we're talking about negative numbers, that's obviously higher. So the indicator is getting better as the price gets worse. That, my friends, is called divergence. MACD divergence in specific because we use the MACD. And look what happened directly after divergence. Price went up. Isn't that spectacular? Okay, you with me? Look at it here. Price made a low here. It made a lower low, but the MACD was higher. Thus, it drew the line, and price went up a little bit directly thereafter. Of course, then it moved away. You can also, don't have to use MACD, you can manually use RSI. Look at this. Here's a low. There's the RSI. Here's the next low. RSI is clearly higher, right? So this is sloping upward, this is sloping downward. So you can use you can use divergence on any indicator you like. I used MACD because it was already programmed on my trusty trade station. All right, there's divergence, new low, higher indicator, new low, higher indicator. Now, let's look at some very key settings on that chart, and then we'll come right back. What is the MACD set to? The default settings, 12, 26, and 9. Okay, it's whatever comes with. I didn't change MACD at all. The RSI on the screen was a length of 4 and then typical 30/70. I didn't change anything. The line on the screen was the 200 period simple moving average, the most famous moving average in the history of mankind or womankind. The take profit is 68 pips because we're using a Forex instrument. And the stop loss was 186 pips. How did I get those? They came to me as if in a dream, or I tested them. It's one of those two. I can't tell you the real answer. So what the system does is this. First, it must see divergence. Ha! Divergence exists. Then it takes the next trade that qualifies. How does it qualify? RSI, set to 4, you know what it is, has to close into oversold, and that's it. Then we go for our take profit or our stop loss. That's it. So once we see divergence, we're assuming that the next trade we take is going up in that direction. This is divergence. The market now has turned. Things are going up. We want long trades. Oh, but that's not enough. We also want it to be above the 200 period simple moving average, which it is. So we must see divergence first. Price must be above the 200. This is as powerful a bullish signal as we can possibly come up with, right? Well, maybe we'll come up with something else someday. But right now, this is the most powerful. We get a trade and it's a winner. We see divergence here. It's above the 200. We get our first reading here, and that's a loser. It happens. How much does it happen? We're about to find out. But that's the system. Dollar yen, daily chart, divergence above the 200. Let's have the RSI set to basic stuff. Take a trade. Okay? There are your settings again. Got it? Here's what happens when we trade this way from 1999 to 2019. Trading one lot, right? Max shares is one lot, no compounding. It made 18,000 and it had a max drawdown intraday of 6,000. 18.3. So 3-to-1 ratio. Not bad. Anything over 2-to-1, we like. Profit factor is excellent. Oh, look at this. Percent profitable, 91%. Better than 91%. That loser we saw doesn't happen a whole lot. In fact, it only happened 3 times in this whole period. Now, we are only taking trades after divergence and the simple moving average. There are not going to be that many trades. We're on a daily chart, and that bears out 37 trades. Not a lot, right? But we're being super picky, and we're using a super powerful tool. So that's the trade-off. We're not going to get a ton of trades. One more thing before we switch screens. The trade close-to-close max drawdown was only $2,200. And what that means is we don't have that many losers, only 3. A trade lost, and then the lost maybe another, right? And you took that close, your equity curve, and the next close, and you added them up. This number takes a loser, and then you get into another trade, and it goes down for a minute, and then it comes up into a winner, let's say. So this is a very important number. We have to have enough cash in our account, but this is the actual number that it goes down in our account. So if we don't see that, let's say we trade and we walk away and we come back at the end, if we did that every time, this is our max drawdown, only $2,200. See what I'm saying? This one I feel like is more real life, but this one is important because if we watch it every second, and we have to acknowledge this, and we have to have enough money in our account to handle this. Okay. Pretty compelling so far, at least it was to me. What if, though, no divergence? It's just silliness. We don't need it. Let's take every trade. Let's use the other 2 variables. Let's go above the moving average, and let's do our basic RSI indicator system. Well, here's what that looks like. As you can see, I left divergence on the screen, but this time every trade is taken. As soon as RSI pops down, we take it. RSI pops down, we take it. We take it. Look at that. It's trading all during the divergence. Okay? So this particular style doesn't care about divergence. Let's see if it's powerful. Well, 280 trades instead of 37. That is a ton more trades, but that makes sense. It's a lot more action, though. Some people like that action. Way more profit, right? How much profit did we have before? Let's take a look. 18,000, 27,000. So we've upped it quite a bit. But we've also upped the drawdown intraday, and we've really upped the drawdown close to close. You get losing streaks here. The win percentage has dropped to 77.5%. Profit factor has dropped, right? Losers have increased. 63 losing trades rather than 3. So because we're trading, close to close, you're going to get actual losing streaks, and the drawdown is much higher. If we look at that, the amount of our account actually goes down, divergence does a lot better. Remember, 7-to-1, 3.5-to-1. So over here, very similar when you're talking about max intraday drawdown, but when you talk about close to close, divergence did a lot better. The bottom line is this. Divergence seems, and everything I looked at this week, divergence made it better. If you get the newsletter for free, I looked at the euro dollar. And the euro dollar, when you started trading without divergence, it got slaughtered. The dollar yen, not quite as bad, but it was way worse on a close-to-close basis. But everything I looked at got better when I added the divergence filter. it improved performance, just sometimes outright, but on a close-to-close basis, it improved it on everything I looked at. So can we just stop there and say, bottom line is this, divergence is great, trade it every time? Well, keep in mind that we kept the parameters exactly the same to keep apples to apples. I think that's fair. But if we need more action, if we want more action, we don't have to keep those same divergence parameters. We can re-optimize and find something that works better in a more active environment. And there is a chance that we could do way better on a drawdown basis and on a profit basis. So I did keep those the same. It doesn't mean you say, well, I don't really need divergence, I need more action. Because if you use divergence, we're probably not going to get as many trades, at least if you do it the way that I've done it. Okay, so it's not exactly the end all be all, but boy, oh boy, it was a powerful tool when we looked at it apples to apples. It really made a difference as long as you don't worry about not trading very much. Okay, I think it's pretty clear. I don't know how you feel. Divergence is a powerful tool. And if you don't like the quality of your trades, I would consider implementing it right away. All right, my lifetime memberships are back where you get all the robots for whatever platform you have. If you have to have TradeStation, I've got some robots for that. But of course, I've got many, many robots from MT4. So if you're interested in getting the robots, everything I do for life, you can go to my website there, Wealth Strategies, and look at membership. All right, that's all this week. There's my contact information. We'll be back next week with more good stuff. Bye for now.